Hello and welcome to Asset TV. I'm your anchor, Laura Keller from New York. I'm joined in our studio by ClearBridge Dividend Strategy Portfolio Manager, Michael Clarfeld. He's here to tell us all about dividend investing and the value it can provide as overall returns soften and volatility spikes. Mike, thanks so much for being here with us.
Thanks for having me. My pleasure.
Now, I know I introduced you as Michael, so I hope that's okay.
That is okay.
Good. Well, now let's start off with where we're at, where we've been this year. We know earnings have been good. How have dividends been performing?
Yeah, it's been a great year for dividends. Last year was a great year for dividends in 2017, and a lot of the growth in 2017 was driven just by fundamental earnings growth. In 2018, that continued. We had terrific fundamental earnings growth, and then in addition, we had the benefit of the tax cut. So the corporate tax cut meant that after-tax net income was even meaningfully higher than it was in 2017, providing a lot of cash for dividends. So it's been a great year. So last year, dividends grew at about 11%, and that has continued this year at about 11%, which we're just thrilled with.
Right. Well, can you give us some examples of some stocks that you own that are representative of your approach?
Yeah. So I think it's important. Our belief in dividends is that the importance of dividends is not just the upfront yield, although that's important as the current income component, but the real power of dividend lies in the compounding of dividends. And that's really why we invest in equities, is to enjoy and benefit from some of the growth in the business. So a great example of a stock that would fit in our portfolio that we've owned for some time is American Tower, which is a cellular tower business. And what's interesting about that is today I think it's viewed as being many people would understand and know that this is a terrific dividend stock. But we bought it when they first went public, and what was interesting was at the time we bought it, the dividend yield was a little low. It came out at less than 1%. But we knew that they'd compound their dividend, and indeed they have. They've been growing their dividend about a 20% rate since they came public 5 or 6 years ago. And through that powerful compounding of dividends, of growth, the dividend has more than doubled, and now it has a very nice, attractive upfront yield in addition to a compelling growth profile.
So American Tower. Well, but jumping to the technology side, many of the FANG stocks, as you know, have been what's pushing up a lot of the equity markets.
Yeah.
But they don't pay dividends for the most part. How does that impact your strategy at ClearBridge?
Yeah, that can definitely be a challenge with us in the sense that in a market like this where so much of the growth is coming from this narrow sector without dividends, it prevents a bit of a headwind. That said, we really take a step back and try to remember what it is we're trying to achieve and how we get there. So with Dividend Strategy, again, the objective is to provide an attractive upfront yield combined with powerful dividend growth and do it in a low-risk, conservative manner. And we're able to use a lot of high-quality tech stocks that are out there, and so it's a different exposure, but still a compelling technology exposure. And while there are times from a relative performance perspective it makes our lives a little more difficult, in the long run with what we're trying to achieve, we don't think it hampers us at all.
Right. Well, talk to me a little bit about volatility, because as we know, it's spiked up in the last 2 months, October and November. How is your active dividend approach, how is it impacted by that uptick in volatility? Yeah,
so that's a great question, and it's interesting because as a dividend portfolio, we believe what we're doing is an evergreen strategy. In other words, it's important in any market cycle, but our phone tends to ring more. Business gets good for us when it might be going poorly for some others. So it's been an interesting year because earlier in the year, the FANG trade was very powerful, and growth stocks continued to march up, and we were going up, but not nearly at the same rate. Since the end of September, the market has obviously gotten very volatile and come in dramatically, and we have gone down. We have not been immune from declines, but we've gone down much less than the market and picked up a lot of ground. So our portfolio, which our belief is, our expectation is that over a cycle we should perform very well. We do that by participating on the upside and protecting on the downside. We feel good that we've done exactly what we were hoping to do in this down cycle, which is to provide a lot of downside protection.
Downside protection. Talk to me about sectors too. Are there ones that you like for dividend yield or dividend growth?
Yeah, so our belief in putting together a portfolio is to try to build a highly diversified portfolio, and that's to both benefit from the positives in all the different sectors of the economy, and also to mitigate the risks so that we're not overly exposed to any one sector. What we look for in businesses is we like to find businesses that have very strong franchises, good balance sheets, and have a predictable recurring revenue profile that we think is going to have nice growth. So what we mean by that is we like businesses with sort of a razor blade model. So whether that's actually a consumer staples company, like a Coke or a Pepsi, or whether it's an industrial company that has a sort of recurring revenue aspect to it, like sort of say 3M, for example, where they don't make capital equipment for manufacturing, they make adhesives which go into, it's an industrial consumable. So We own things in all different sectors and not just one sort of revenue profile, but what we like to find across our portfolio is companies with predictable growing revenues with pretty little cyclical economic risk.
Well, talking about cyclical, and maybe this isn't so cyclical nowadays, but the Fed has changed paths. Where we thought the interest rate hike path was going to be has changed. There's a little more uncertainty there now. How is that something that affects you or not?
Yeah, so I think obviously the direction of the Fed is critically important for everybody. And I think there's a perception that we have an increased sensitivity to it as a dividend portfolio. I think we would push back a little bit on that widely held belief that we're overly sensitive to that, or that's particularly of focus with us, in the sense that what we frequently see is that when changes around perception of Fed hikes come into the marketplace, so we see that all of a sudden people expect rates to go up a lot, or maybe they're not going to go up as much as people were previously thinking. Our dividend stocks often are overly sensitive to that in the short run. But over the longer term, that sort of normalizes out. And I guess where we stand today and what we think about the path of the Fed and about dividend positioning, I think is a few things. So number one, I think we think interest rates are going higher. We don't have a strong prediction about that, like we expect so many hikes next year or the year after. It's more of a big picture perspective, which is just that we're coming out of this period of quantitative easing, quite literally the lowest interest rates in human history. The trend will be to go up over time at some pace. Dividend growth is a very powerful thing to have in your portfolio in that kind of environment, because that growth enables you to offset the headwind of rising rates. So we think that's critically important. The other piece I think that we think is important is not just the growth piece, but the protection piece, which is, we're clearly in the later innings of this market cycle, whether we're seeing the sort of the end of it in here, or whether it goes, hopefully the market continues to go up for another year or two. We're in the later innings, and as the market rolls over, our high quality businesses with great balance sheets, predictable revenues, little economic sensitivity, and importantly, dividend support should provide a lot of protection. So with the potential for rising rates, or the expectation for rising rates at some trajectory going forward, we like our dividend growth. And with increased volatility and increased concerns about the next down cycle in the market, we like the downside protection from dividend support. So we feel really good about where we're at.
Okay. Well, you brought us to outlook for the end of the year here.
Yeah.
What do you think is going to be the biggest driver behind dividend growth? And what is your approach at as far as value?
Yeah. So from a dividend growth perspective, there's two parts to how to think about dividend payouts. And the first one would be payout ratio. So how much of a company's earnings are they currently paying out? The lower it is, the more capacity they have to raise dividends. The higher it is, the less capacity. The second piece would be earnings growth. So we always think that the potential for dividend payouts, dividend growth, and also the safety of dividends is a combination of those two things. From a payout ratio perspective, our portfolio is between 40 and 50%, which we think is a healthy level. In other words, it's not ahead of itself. It doesn't have undue risk in that they're paying out too much of their earnings. And we think that earnings growth should continue to be reasonable in the next couple of years. So we feel like we're in a good place to continue to see continued dividend increases. That said, I think I mentioned earlier that we've enjoyed 11% dividend increase this year and last year. We would caution people not to draw a straight line of 11% in the future. We think high single digits is probably a good expectation.
Still pretty good, I think.
That's what we would say. There's not a lot of places, as we like to say, not a lot of places you can count on getting a 7, 8, 9% raise every single year.
Right, exactly. Yeah. Well, thanks so much, Mike. That was really helpful.
My pleasure. Thanks a lot for having us.
Thank you. And thank you for watching here on Asset TV. We've been speaking with Mike Clarfeld. He's portfolio manager at ClearBridge.